Hi, my name is Christian Waldegrave, Manager of Research at Teekay, and this is our conventional tanker market update for July 2014. Now normally when we get into this part of the year, into the third quarter, it's usually the weakest part of the year for spot tanker rates, especially since the financial crisis in 2008. Q3 has seen some very low tanker rates, and it's not uncommon for this time of year for Aframax spot rates to be averaging in the $10,000 to $12,000 per day range, or even lower than that. We've certainly had times during Q3 in the last couple of years when rates have been in the single digits. But this year is proving to be a little bit different, and especially in the last week or two, we've seen some incredible volatility in tanker spot rates, particularly in the mid-size ranges. And I think that's due to a variety of factors. First of all, there is quite a bit of geopolitical instability in different parts of the world. And that's causing a bit of a threat to global oil supply, which could be causing some people to stockpile oil. And we saw this particularly a few weeks ago towards the middle and the end of June, when we saw the insurgency in Iraq. And there was some worry that if that fighting spread south into the southern part of Iraq, that could threaten the oil fields there and the oil supply that comes out of Iraq. And that we saw straight after that a bit of a boost on the spot tanker rates, particularly the bigger tankers, the VLCCs and the Suezmax, possibly because some people were buying extra oil in anticipation of supply disruptions or higher oil prices in the future. So that started to give a bit of a boost to tanker rates. More recently, in the last week or two, we've also seen some other events, such as the tragic events in the Ukraine and in Israel and Palestine. And when you couple that with what's going on in Iraq and Libya, there's just a lot of geopolitical uncertainty, a lot of uncertainty over oil supply. And I think that uncertainty brings in a bit of extra activity so that charterers are covered and protected a little bit from any potential supply disruption. So I think that's causing a bit of volatility as well. In addition to that, on the Suezmaxes, what we've seen is that a lot of Suezmaxes have been trading in the east and have been moving out into the eastern market, into the Pacific, and some of those ships have stayed in the Pacific. We've certainly seen a big increase in ships moving east this year, and then an increase in Suezmaxes loading in the Middle East. And that means that when the cargoes start to come up in the Atlantic, as they have done in the last couple of weeks, there have been fewer Suezmaxes in the west to transport those cargoes. So the market is a little bit tighter for Suezmaxes in the Atlantic basin than it's been in a while. And when you couple that with some other factors, such as some ship delays in Trieste in the Mediterranean, then it's made for a very, very volatile spot market. And in this past week, we've seen on the Suezmax spot rates averaging about $50,000 per day out of West Africa, and as much as $70,000 to $75,000 per day in the Mediterranean and Black Sea region. And that volatility on the Suezmaxes has also spilled a bit over to the Aframaxes, again triggered by some of the same kind of factors that are affecting the Suezmax. Also on the Aframax side, we see that Libyan oil production is coming back up a bit now. Libya is expected to add about 500,000 barrels a day of production to bring that production back online in the next few weeks. And those barrels are starting to be marketed now. So that's creating extra demand for Suezmaxes in the Med. And on the other side of the Atlantic, in the Caribbean, there's also delays due to ullage, which is causing giving some strength to rates as well. So again, in the Aframax sector, we've seen rates get up to almost $40,000 per day in the Caribs, $50,000 in the Med Black Sea region. And in the cross UKC, in the North Sea, rates jumped about 60 to 70 world scale points in just a couple of days this week to reach $75,000 per day. So these kind of rates at this time of year is very unusual. It's not something that we've seen probably since 2008, when the market was very strong. And it is caused by some factors which are probably short-term in nature, but at the same time I think it's also a reflection that with trade patterns shifting, Suezmaxes especially getting pulled longer haul into the Pacific, the market is tightening, and it's probably quite a bit tighter than we've seen for many years, and that's what's causing this volatility in rates. And so I think we would expect that as some of these short-term events start to dissipate, I wouldn't be too surprised if the rates do soften and we get that seasonal weakness again in August and September. But I think it's setting us up for a very good winter market. And we're getting more and more confident that this tightening market could set us up for a pretty good winter, especially when you take into account some of the fundamentals, such as the call on OPEC is expected to go up by over 1 million barrels a day in the second half. So we should see more oil on the water and more OPEC production. The tanker fleet's not really growing on the crude side. The Suezmax fleet hasn't grown this year, and the Aframax fleet has shrunk by 13 or 14 ships. So there's no supply growth, and that's going to set us up for a tighter market this winter and going into 2015 and 2016. So that's our update on the conventional tanker market for July, and we'll speak to you again next month.